Most traders wait for a stock to move 2%, 3%, sometimes 5% before they even think about entering. That's the amateur's fatal error. By then, the smart money has already taken half their profit and moved on. What if I told you the real money isn't made in the big move? It's made in recognizing and trading the first half of that move, then getting out before the crowd even knows what happened. This is the one-half momentum hack, and it separates the professionals from the broke. Here's the brutal truth. 87% of retail traders miss 60% of profitable momentum runs because they're waiting for confirmation that never comes in time. They see a 5% rally and think, I'll wait for it to pull back and test support. Meanwhile, the stock's already climbed 7% and they've frozen. The professional, though, he's already in on the first half move, already secured his 2 to 3% profit, and is sitting on the sidelines watching the amateurs panic buy at the top. This isn't about being greedy. This is about understanding that the first half of any momentum move is the cleanest, most predictable, least crowded trade you'll ever see. It's the moment before the herd arrives. Jesse Livermore wrote in his tape studies, "The tape doesn't lie, but it whispers before it screams. That whisper is the half move. The moment you hear it, you trade it. The amateurs are still sleeping. I spent 5 years watching traders blow accounts, chasing the entire momentum move, buying at the top, holding into reversals, and wondering why they're always 2% late. The ones who survived? They took the first half and walked. No emotion, no hope. Just half the move, half the risk, and out." In this video, I'm going to show you exactly how to spot that first half before anyone else sees it, how to size into it without blowing yourself up, and, most critically, how to exit it with discipline before greed rewires your brain. This isn't a get-rich-quick hack. It's a get-consistent, quick method that works because it respects one timeless rule. The first move always belongs to the informed. The second belongs to the desperate. Which one are you? The one-half momentum hack flips conventional wisdom on its head. Most retail traders wait too long for confirmation, missing the crucial first half of momentum runs. By the time they enter, the smart money is already locked in profits. The professional mindset rejects the hunt for the full move, and instead targets the cleanest, earliest 50% of any rally, where risk is lowest and conviction is highest. Historical data shows that 87% of retail traders miss the initial thrust because they're frozen by indecision or waiting for pullback confirmation. Meanwhile, the professional has already secured 2 to 3% profit on the first half move and exited before the herd arrives. This approach isn't greedy, it's protective. Jesse Livermore's tape wisdom, "The tape whispers before it screams," perfectly captures this idea. The whisper is the half move. The scream is the stampede of amateur capital flooding in at the top. The competitive edge lies in recognizing and executing on that whisper, then stepping aside. Trading the first half dramatically reduces the time you're exposed to reversal risk, slashes your emotional baggage, and keeps you disciplined. The remaining chapters reveal how to spot these half moves using tape reading techniques, position sizing rules, and exit protocols that guarantee you leave before the reversal. This is the framework that separates consistent traders from account blowers. Understanding the mechanics of early entry, the psychology of discipline, and the mathematics of position sizing creates a foundation that withstands market volatility and personal emotion. The key distinction between amateurs and professionals isn't intelligence, it's timing awareness. Amateurs believe bigger moves mean bigger profits. Professionals know that early moves mean safer profits. The herd always arrives late, after the cleanest part of the move is already passed. By that point, the institutional traders, the informed money, have already distributed their positions to eager retail buyers who are now holding the bag. This is the game. This is why the one-half momentum hack works. It exploits the natural delay between information arrival and herd execution. When tape signals appear, only the fastest, most disciplined traders act. Everyone else is still reading yesterday's news or waiting for a candle pattern that confirms what the tape already revealed hours ago. The psychological edge is even more critical. Most traders are emotionally wired to hold and hope, to wait for the big move that validates their conviction and feeds their ego. Holding a winning position feels good. Exiting at 2 to 3 profit feels incomplete, like leaving money on the table. This emotional resistance is exactly why amateurs blow up. They exit too late, after the move has reversed, or they never exit at all. They hold until the entire gain evaporates. The professional has rewired his brain. His definition of success isn't the size of the move, it's the frequency of clean wins. 10 trades at 2.5% profit each equals 25% return. One trade at 15% profit offset by 2 blowups equals negative return. The math doesn't lie. Frequency beats magnitude every single time. This is where patience becomes power. The 1/2 momentum hack isn't about being fast. It's about being selective. You'll see dozens of setups weekly, but only a handful will show the tape signals that separate high probability half moves from low probability full move chases. Waiting for those perfect setups, refusing to force trades out of boredom or FOMO, builds discipline that compounds your edge. Every trade you don't take is as valuable as every trade you do take, sometimes more valuable. The amateurs take 50 trades monthly. The professionals take 8 trades monthly, each one precise, each one profitable, each one respecting the half-move boundary. By the time this video ends, you'll understand not just the what of the 1/2 momentum hack, but the why behind it. You'll see the market the way professionals do, as a series of whispers, each one an opportunity to capture clean profit before the screaming herd arrives. You'll recognize that the first move always belongs to the informed, the second always belongs to the desperate, and the third belongs to the liquidators. Your job is to be the informed. Your job is to trade the whisper, exit on strength, and walk away with your 2 to 3%, knowing full well that the amateurs will spend the next 3 hours explaining why they didn't take the trade or why they held too long. This is the identity shift that separates broke traders from rich ones. Not intelligence, not luck, identity. The professional identity is someone who takes half and walks. The amateur identity is someone who holds and hopes. Which identity will you choose? Here's what most traders don't realize. The half move is visible before it happens. Not through magic, through the tape. The problem is, amateurs are watching price bars and volume histograms like it's a slot machine, hoping for a bell to ring. Professionals are reading order flow, tape structure, and market participant behavior. Let me give you a concrete example. Last month, I watched a tech stock consolidate for 3 days between $152 and $155, classic base. The amateurs saw this and immediately thought, breakout coming, I'll wait for the candle close above $155.50. The professionals, though, they were already watching the tape, watching large buyers stepping in at $153, watching sellers getting smaller, watching the bid-ask spread tighten. That's the whisper. When you see those patterns, institutional accumulation, shrinking spread, buyer aggression into support, the tape is telling you something the candlestick chart cannot. The stock ran from $153 to $157 in 18 minutes. The professionals who read the tape took the first half, $153 to $155.50, 2.5%, and exited into strength. They didn't care about the remaining 1.5% that came after. Why? Because that's when the herd arrives, and the herd stampedes out just as fast. The protocol is simple. Watch 3 things on the tape before you enter a half move. First, institutional footprints, large size at support, consistent bids showing conviction. Second, liquidity structure. Is the bid-ask spread tightening or widening, because tightening means fewer sellers willing to resist? Third, absorption. Are sellers getting absorbed, or are they fighting back with fresh supply? When all 3 align, you have a high conviction entry. You size small, this is critical. Take your half move, typically 2 to 3% from entry, and exit into strength. No hope, no waiting, no what if it goes higher. The tape doesn't reward waiting. It rewards recognizing the signal before the signal becomes obvious. This is why professionals make money in the first hour of trading, while amateurs are still setting alerts. The tape moves fastest when information is newest. That's where the 1/2 momentum hack lives. Most retail traders completely misunderstand what the tape actually shows them. They think volume bars confirm strength, that high volume means big moves are coming. Wrong. The tape shows intent. A single large bid at support reveals more about future direction than 50 bars of climbing volume ever could. That bid is institutional capital saying, we're buying here and we're serious. When you see that bid absorbed repeatedly without breakdown, without sellers, stepping in aggressively, you're watching the tape whisper. The amateurs miss this because they're zoomed out, looking at 5-minute candles or 15-minute charts, waiting for some technical setup to align with their trading plan. The professionals are zoomed in, watching the level 2 order book, tracking individual large buyers, understanding the sequence of order flow. This is the fundamental skill gap. It's not predictive, it's observational. You're not predicting the stock will run. You're observing that large institutional buyers are already accumulating, that sellers are already backing away, that the spread is already tightening. These observations precede price movement by minutes or even seconds. That's your edge. That's your whisper. Let me walk you through exactly what that tech stock looked like on the tape. At 9:47 a.m., the stock was sitting at $152.80. Bid-ask spread was 8 cents wide, normal for this equity. Then at 9:48, a large bid of 25,000 shares appeared at $153. Within seconds, 18,000 shares got absorbed. The bid refreshed for another 22,000 shares. The amateurs saw this and thought, okay, maybe something's happening. The professionals saw this and knew. Large institutional size at support, buyer conviction, and support holding, that's the first signal. Then at 9:49, the spread tightened from 8 cents to 4 cents. The bid-ask became compressed, which means sellers were backing away, reducing their offer quantity. That's the second signal. By 9:50, 3 attempted sales at $153.50 and above were getting absorbed without breakdown. No new lows, no sellers stepping in below support. That's the third signal. All three aligned. High conviction entry. The stock ran from $153 to $155.50 in 4 minutes. The professionals who read the tape took that first half and exited into the strength they saw building. The amateurs were still watching the 1-minute candles warm, wondering if they should enter once the close confirmed above $153.50. By then, the stock was at $155, and they entered at the exact wrong moment, right when the smart money was exiting. This is the consistent pattern. The tape always whispers before the chart screams. The professionals always hear the whisper. The amateurs always chase the scream. The protocol then is actionable and repeatable. You need a level 2 order book or a tape reading platform. You watch support levels, known areas where institutional buyers have previously accumulated. You watch for the 3 signals: large institutional size, tightening bid-ask spread, and seller absorption without breakdown. When all 3 appear together, you have your entry. You size at 0.5% to 1% risk maximum. We'll cover sizing later. You take your half move, which is typically 2% to 3% above your entry point, and you exit into strength, never into weakness. You ignore the remaining move. You ignore FOMO. You ignore your ego telling you that you left money on the table. You took the cleanest, most informative part of the move and walked. This is the professional approach. This is why professionals make money in the first hour while amateurs are still scratching their heads at the close. The tape doesn't lie. It whispers. Your job is to listen, act, and exit before the herd even wakes up. The remaining chapters will show you exactly how to size without blowing up, and how to exit with discipline when your brain screams to hold. But first, you must accept this fundamental truth. The tape reveals the half move before price charts ever can. Everything else flows from this single insight. Master the tape, and the half move becomes obvious. Master the half move, and consistent profits follow. I knew a trader named Marcus who had cracked the 1/2 momentum hack in 6 months. He could read tape like a savant. His entries were beautiful. His timing was crisp. Then he blew up. Not because his system was wrong, because he forgot rule number 1, position size protects position timing. See, when you're trading half moves, you're playing a game of frequency over magnitude. You win 70% of your half move trades, but each win is small, only 2 to 3%. If you size like you're swinging for a home run, 1 loss, just 1, erases 10 wins. That's the math amateurs ignore, and it's why they end up broke. Here's the hard rule that separates professionals from the liquidated. Your position size on any half-move trade must be small enough that you can lose 5 in a row and still have 95% of your account intact. This isn't pessimism. This is pure mathematics. Let's use concrete numbers because numbers don't lie, and they don't care about your feelings. If your account is $100,000 and you risk 0.5% per trade, that's $500 per trade. You can theoretically take 200 consecutive losing trades before you're completely wiped. Most amateurs risk 2 to 3% per trade on half moves, thinking they have a 70% win rate so they're safe. Then 3 losses hit in a row, which is statistically normal, not catastrophic, and suddenly they were panicking, over-leveraging the next trade to make it back, and boom, the account is gone. This is the blow-up cycle, and it's more common than you think. Marcus made exactly this mistake, and his story is instructive because it shows you that skill and analysis don't protect you from sizing stupidity. He was up $47,000 in 3 months trading half moves at 1% risk per trade. His tape reading was genuinely exceptional. His entries were clean. Then his win rate dropped to 62% for 2 weeks. Nothing unusual, just normal variance in a 70% system. Instead of accepting this variance as part of the game, instead of trusting his process, Marcus panicked. He thought, I'm losing my edge. I need to make it back. Faster. So he doubled his position size to 2% risk. 5 losses hit in a row during that 2-week period. He was down $38,000 of his $147,000 account. Now he was terrified. He panicked and went all in on the next trade, convinced it would be a winner. It wasn't. His $107,000 became $6,000 in 90 minutes. A 6-month edge destroyed in one moment of sizing stupidity. This is the reality that amateurs don't want to hear. Your edge doesn't matter if you can wipe yourself out before the edge has time to compound. Position sizing isn't boring. Position sizing is survival. The professional rule is ironclad and non-negotiable. Position size small enough that you can never wipe yourself out, then compound through frequency, not magnitude. Let's do the math on 100 half-move trades at 0.5% risk with a 70% win rate. 70 wins at 2.5% gain each equals a $1,750 and a $100,000 account. 30 losses at 0.5% risk each equals a $150 loss. Net result, $1,600 profit, or roughly 1.6% return per cycle. Run that cycle 10 times in a year, 100 trades total, and you're looking at approximately 16% annual return, with minimal drawdown, minimal emotional stress, and 0 blow-up risk. That's wealth compounding. That's how real money is made in markets. Compare that to what amateurs do: 10 trades at 3% risk with 1 loss erases 3 wins. 1 cold streak and they're emotionally broken, second-guessing their system, increasing risk out of panic, and ultimately blowing up. The frequency approach is mathematically superior and psychologically superior. You're taking more frequent small wins, which keeps your confidence stable. You're reducing your exposure to single-trade catastrophe. You're letting mathematics do the work, instead of relying on unbeaten win streaks. Marcus's mistake was conflating his entry skill with his risk management. He had cracked the tape reading problem. That's real, but he had never internalized the sizing rules, so when variance hit, he crumbled. He thought, my system is so good that I can risk 2% or 3% because I'll win most of them. Wrong. Even a 90% win rate system can experience cold streaks. A 70% win rate system will experience them regularly. If you've sized for a 90% win rate and you only hit 70%, you're blown up before the math catches up. The professional sizes for worst-case variance, not best-case performance. Here's what the professional mindset actually looks like. I will trade the half move with a 70% win rate, but I'm sizing as if my win rate might drop to 55% for 2 weeks. I'm sizing as if I might get 5 losses in a row. I'm sizing as if variance is real. This is why professionals survive and amateurs don't. It's not smarter analysis. It's disciplined risk architecture. The formula is simple. Account size x risk percentage per trade, stop-loss distance equal to position size. If your account is $100,000, you risk 0.5%. Your stop-loss is 1% from entry. Then your position size is $100,000 x 0.005, 0.01, equal to $50,000 notional exposure. That's large enough to profit meaningfully from a 2-3% half move, while small enough to never destroy you. The amateurs who risk 2 to 3% per trade are betting that they'll never experience the variance that's mathematically guaranteed to occur. They're playing a game with the odds against them, and they don't even realize it. Fast action profits come from discipline in sizing, not from conviction in analysis. This is what separates professionals from the broke. Marcus had the conviction. He didn't have the discipline. One of those is learnable, one of them is not. Which will you choose? The one-half momentum hack lives or dies at the exit. I'm serious. I've seen traders nail every single entry, perfect tape reads, perfect size, then give back 60% of their profit because they stayed in. Just a little longer. This is where the amateur brain hijacks the professional plan. You see your $2,500 profit, and your brain whispers, what if it goes to $30,500? What if this is the big one? So you hold. The stock peaks at 157.40 cents. You feel genius. Then a seller shows up, then another. By the time you exit, you're at $156.20, and your $2,500 profit is $1,200. You just gave the market 50% of your edge for nothing. This happens hundreds of times daily across thousands of trading accounts. The pattern is identical. The outcome is always the same. Here's the rule that changes everything. Exit the half move into the first show of strength, not into the first sign of weakness. This is backwards to how amateurs think, which is exactly why it works. Amateurs think, I'll exit when volume drops, when the candle looks weak, when I see a red bar. Their logic seems sound. Sell weakness, buy strength. But that's backwards in the context of half moves. Professionals think differently. Professionals think, I'll exit when buyers are loudest and most aggressive. Why? Because that's before the turn. By the time you see weakness, by the time volume dries up and red bars appear, the smart money has already left. You're exiting into the stampede of retail buying. You're fighting for liquidity in a crowded market. The professionals are already gone, their positions distributed to you at the top. A practical example will make this crystal clear. You enter at $153 with tape confirmation, large institutional accumulation, tightening spread, strong absorption. All three signals aligned, so you sized small, 0.5% risk, and you're in. The stock runs quickly to $154.50. You're up 1.3% already. Then something crucial happens. You see a large bid come through, buyers stepping in aggressively, lots of size, buyers stepping up into the offer. To the amateur, this looks like confirmation, like the move. Just getting started. The amateur thinks, this is it, the big one. I'll hold. The professional sees this differently. The professional sees that large bid and thinks, that's distribution. That's smart money selling into this bid. That's my exit signal. You hit the offer and you're out with your 2.3% gain. The stock continues to $157 over the next 15 minutes. You watched it go higher. Then at $157.20, a wave of selling hits. Large sellers step in. Volume spikes. The stock reverses hard. By end of day, it's back to $155. The amateurs who stayed through the peak to the reversal, they gave back everything. Some even have losses if they held too long. You're not mad. You took your half move cleanly. You're already out, already profitable, already moved on. This is the psychological advantage that separates professionals from the broke. The exit rule is absolute and non-negotiable. Don't wait for profit-taking. Initiate profit-taking when strength is loudest. This seems counterintuitive, because it defies the traditional trading wisdom of letting winners run and riding trends. But the one-half momentum hack isn't about trends. It's about the first half. The first half always peaks when buying is loudest. After that peak, the herd arrives, and the herd always leaves just as fast. The critical skill is recognizing that loud buying is not confirmation of further upside. Loud buying is distribution. It's the moment when smart money is exiting and retail money is entering. This recognition requires discipline, not intelligence. Any trader can hold and hope. Professionals exit into strength. This defies your ego, which is precisely why most traders can't do it. Your ego wants to ride the full move. Your ego wants to feel the rush of a 5% or 10% gain. Your ego wants to post screenshots of peak-to-peak profit on social media. But that feeling is expensive. It costs you frequent. Sigh. It costs you consistency. It costs you sanity. A trader who takes 52.5% gains cleanly compounds faster than a trader who chases one 15% move and two 40% losses. The math is simple. The psychology is brutal. The fast action profits come from respecting the half-move boundary and exiting before the herd arrives. This is non-negotiable. Here's what happens in your brain. When you're in a winning trade, your dopamine system activates. You feel like a genius. You start imagining the bigger move. You start seeing reasons to hold, technical support below, institutional buyers, strong fundamentals, whatever narrative fits. You start rationalizing. You stop thinking. And then the reversal hits, and all that dopamine turns to panic. You're underwater. You're emotionally broken. You exit at the worst possible moment. The professional has built a system that removes this emotional decision-making. The professional has a rule, not a feeling. The rule is, when strength shows, you exit. No negotiation, no hoping, no narrative, just execution. You exit into the loud buying because that's when the odds are best that you will get filled, that you'll get best execution, that you'll lock in profit. Everything after that exit is gravy for someone else. You don't need it. You've already won. This discipline, this ability to exit into strength while your brain screams to hold, is the psychological skill that separates the top 5% of traders from everyone else. It's not about being smarter. It's about being more disciplined than your own emotions. Here's the paradox that breaks amateur brains. Sometimes the best trade is no trade. Not for a day. Not for a week. For weeks or months. And this is part of the one-half momentum hack, not a contradiction of it. The amateurs see momentum hack and think, fast action, constant trading, always in motion, always grinding, wrong. The professionals know teach. At waiting is a position. The most disciplined traders I've known, the ones with 60% plus annual returns year after year, spend 70% of their time waiting for the tape to whisper that first half-move signal. The rest of the time they're executing. This ratio seems backwards until you understand the math. 100% high conviction trades beats 500 low conviction trades every single time. The professionals aren't lazy, they're selective. They're protecting their capital and their sanity by refusing to trade garbage setups. Let me show you why this matters with a real example. A trader named Sarah was brilliant at reading tape. She could spot the half-move setup in her sleep. Her technical knowledge was exceptional, her pattern recognition was sharp, but she was impatient. She'd see a stock that looked like it might set up soon, so she'd enter early, trying to catch the whisper before it arrived. She thought she was being proactive. She was actually being reckless. She'd lose money 40% of the time, not because her system was broken, but because she was trading hope, not signal. She was entering on the anticipation of the 3 tape signals aligning, not on the confirmation that they had aligned. Then she learned the rule that changed everything. Only trade when all 3 tape signals align simultaneously. No exceptions, no early entries, no hope-based positions. For 2 weeks, she took 0 trades. Her account made $0. She watched setups that almost worked. She watched stocks consolidate that might have broken out. She watched and did nothing. Most traders would have cracked. They would have said, "This rule is too restrictive. I'm leaving money on the table." Sarah didn't. She held the line. Her win rate jumped from 65% to 78%. Let me repeat that because it's critical. By trading less, her win rate went up. Why? Because she was now trading the actual signal, not the anticipation. She was no longer fighting the market's pace. She was dancing with it. Over 3 months, that discipline, that waiting, made her $18,000 more than her impatient self would have made. Think about that. Not trading for 2 weeks made her $18,000 extra. The opportunity cost of discipline is actually negative. Waiting isn't laziness. It's selectivity. It's respecting the market's signal instead of imposing your opinion on it. The professional mantra is simple and powerful. I wait for the market to come to me, not the other way around. The market whispers when it's ready to whisper. The tape signals when conditions are right. Your job is not to predict when that will happen or to force it to happen. Your job is to be ready, to recognize it instantly when it arrives, and to execute with precision. Amateurs exhaust themselves in bad trades, trying to force opportunity. They trade every setup that looks close enough. They take early entries on almost confirmed signals. They compound their mistakes through overtrading. Professionals preserve energy for the moment the tape actually whispers. They understand that missing 1 good setup is better than taking 10 bad setups. The compounding effect of high-conviction trades is superior to the compounding effect of frequent trades with lower conviction. You can't trade 500 times a year at 1% risk and expect consistency. The variance will crush you. The emotional toll will break you. But you can trade 100 times a year at 1% risk, wait for the real signals, and compound like you're printing money. The math is stark. 100 trades with a 70% win rate at 2.5% per win and 0.5% per loss equals roughly 170% annual return. 500 trades with a 60% win rate at 0.5% per win and 0.5% per loss equals roughly 50% annual return. The patient trader compounds faster than the hyperactive trader. The one-half momentum hack isn't about being fast. It's about being right when it matters. Fast is a byproduct of being ready. When the tape signals, professionals move instantly because they've been waiting. They're not slow. They're not lazy. They're prepared. The amateurs are unprepared. They're always trying to catch up, always trading from a position of reaction. The professionals are always positioned for execution, which means they're always positioned to wait. This is the psychological distinction that separates the top performers from the struggling masses. The professionals have trained themselves to find peace in waiting. They've trained themselves to see inaction as action, to see no trade as a trade, to see discipline as its own form of execution. The waiting separates the profitable from the broke. The waiting separates the consistent from the emotional. The waiting separates the professional from the amateur. If you can't wait, you can't trade the one-half momentum hack. If you can wait, you've already won half the battle. We've covered a lot ground in this journey. The tape reads the half move before price does. Position size protects timing. Exit into strength, not weakness. And waiting is a position. But here's what ties it all together. The thing that actually makes the one-half momentum hack work at the deepest level, you have to own the process, not the outcome. This is where amateurs and professionals diverge completely. The distinction isn't subtle, it's fundamental. It rewires how you think about trading entirely. The amateur tracks his P&L obsessively. He's up $5,000 on Monday and feels invincible. He's imagining bigger accounts, faster cars, early retirement. He's enslaved to outcome. He's down $2,000 on Wednesday and questions everything. He questions his system. He questions his tape reading. He questions whether he even has an edge. His entire emotional state rides on daily variance. The professional tracks his process. Did I follow my tape reading rules? Did I size correctly? Did I exit on strength? Did I wait for the signal? If the answer to all four is yes, then the outcome, profit or loss, is irrelevant. He's indifferent to daily P&L because he understands the mathematical reality. Over 100 trades, process wins. Over one trade, outcome is random. This is the cognitive shift that separates wealth from poverty. The brutal truth that amateurs refuse to accept. You could execute the one-half momentum hack perfectly and still lose money on a given day or week. You could nail all 5 pillars, read the tape correctly, size appropriately, exit on strength, wait for signals, own the process, and still end up red. That's not failure. That's variance. That's mathematics. But if you execute perfectly 100 times, you're making money. Professionals understand this deeply. Amateurs don't, which is why they self-destruct when they hit cold streaks. A professional experiences 5 losses in a row and thinks, my process is sound, this is normal variance, I'll continue executing. An amateur experiences 5 losses in a row and thinks, my system is broken, I need to change everything, I need to increase size to make it back. The amateur's response guarantees the blow-up. The professional's response guarantees eventual profit. Here's the actionable recap. The 5 non-negotiable pillars that form the complete one-half momentum hack protocol. First pillar, read the tape, not the chart. Watch institutional footprints at support levels. Watch bid-ask dynamics tightening and spreading. Watch seller absorption strength. These 3 signals must align before you enter. The candlestick chart is irrelevant. The round numbers are irrelevant. The volume histogram is irrelevant. Only the tape matters. Second pillar, size small enough to never blow. WP, 0.5% risk per trade is professional grade. 1% risk per trade is acceptable if you're disciplined. Anything more than 1% is ego, not calculation. The math is simple. At 0.5% risk with a 70% win rate, you survive 200 losing trades. At 3% risk with a 70% win rate, you survive 6 losses before you're wiped. Which one sounds sustainable to you? Third pillar, exit into strength, not weakness. When buyers are loudest and most aggressive, you leave. Not when red bars appear, not when volume dries up, not when you feel weakness. Exit on the first show of institutional buying because that's distribution. That's smart money leaving. That's before the reversal. Fourth pillar,
Wait for all three tape signals to align. No early entries. No hope-based trades.
No almost confirmed setups. Only when institutional footprints, bid-ask dynamics, and seller absorption all say yes simultaneously do you enter. This discipline costs you nothing in the long run. It gains you everything. Fifth pillar, own the process, not the outcome. If you followed all 4 rules above, you won, even if you lost money on that trade. Your job isn't to win every trade. Your job is to follow the process. The wins follow naturally. This mindset compounds wealth because it prevents emotional decision-making. It also compounds discipline because you're not chasing profits or revenge trading losses. You're building a sustainable system. The 1/2 momentum hack isn't a get-rich-quick hack. It's a get-consistent-quick methodology that works because it respects tape logic, respects position mathematics, and respects psychological truth. The tape doesn't lie. Position sizing prevents blow-ups. Psychology determines long-term success. If you've internalized these 5 pillars, you're ahead of 95% of traders. Most traders are still chasing candles. Most traders are still sizing like they're swinging for runs. Most traders are still holding into reversals. Most traders are still trading hope instead of signals. Most traders will be broke in 5 years. You won't be, if you follow this protocol. The next video will deepen your tape reading skills even further, because mastering the whisper, hearing it before the herd even wakes up, is where real fortune lives. That's the advanced level. That's where you move from consistent to exceptional. For now, own the process. That's everything. The process is the foundation. Without it, you have nothing. With it, you have an edge that compounds year after year. You have an edge that survives market cycles. You have an edge that turns small accounts into large accounts, slowly and sustainably. The 1/2 momentum hack trades small, waits long, and exits fast, a rhythm that respects both market logic and human psychology. Mastery of these 5 pillars puts you in the top 5% of traders. That's not an exaggeration. That's a statistical fact. Most traders fail because they skip these fundamentals. They want shortcuts. They want faster paths. They want to skip to the advanced stuff. The professionals know better. The professionals master the basics first. They own the process. And through owning the process, they own the market. Now it's your turn.